A very good afternoon, ladies and gentlemen. Welcome to the 22nd of September weekly market review. Today I have with me Gerald. How are you, Gerald?
Hi, Sunny. Hi, everyone who has joined us today. Very well, coming to the end of September or the third quarter of the year and going into the final quarter of 2025. We continue to see quite a lot of developments in the financial markets, especially with the rate cut that we saw in the past week.
Yes, indeed. At the start of the month, I remember us saying that seasonally, the index used to be very negative in the month of September, but this year around, it seems that that's not the case. Okay, last week we saw all the US three indices up by more than 1% on the weekly performance. On the Singapore side, we are still holding above the 4,300 points for the STI Index, and we also got the latest development from our regulators, I would say, that we are going to see a new index called the Next 50 Index. I think Gerald will take us through some of the details on the Next 50 Index, right?
Yes. So I'll be sharing more about the Next 50 index in today's weekly market review. So before we start, just a disclaimer that today's sharing is for informational purposes only and should not be taken to be financial advice. If you find the weekly market review helpful, do leave us a review on Google by scanning this QR code or going to the website that is shown here. If you'd like to join SIAS as a member, you can also go to the website sias.org.sg/membership. And as a SIAS member, you can access various online resources as well as investor education programs. So over the past week, we saw the US stocks reaching record highs. We now have the S&P 500 at 6,664 points with a 1.2% gain in the past week. We can see that a lot of the gains are driven by the tech stocks, and the Nasdaq also reached a new all-time high with a 2.2% gain in the past week. Okay, so that is reflecting the interest rate cut by the US Federal Reserve that I'll also share more about later. In Singapore, we have the STI coming down slightly to 4,303 points after the strong gains that we saw in the previous weeks. So what happened in the past week is that the US Federal Reserve cut interest rates as expected by 25 basis points or 0.25%. So effectively, we have seen the Fed pausing on the rate cut since the start of this year, and this actually reflects the first rate cut since December 2024. Okay, but as the rate cut is largely expected, given the inflation data that we have seen over the past few months, given the employment data that we have seen in the past few months, we did not see the stocks reacting very significantly at the back of that. Okay, so this is the chart of the US one-year government bond yield, reflecting the Fed rate cut. It actually came down since the start of this month to now below the 4% level. And likewise, if you were to look at the one-year Singapore government bond yield, also staying at fairly low levels, now at about 1.77%. Okay, apart from the rate cut that was announced, the Fed also projected further rate cuts of 0.5% for the rest of 2025. So that is broadly in line with what the market is expecting, as reflected in this CME Fed Watch 2. So we may potentially see two further rate cuts in the upcoming October and December meetings, and then potentially two further rate cuts in 2026. Okay, so with the rate cuts largely expected, we did not see significant movements in the Singapore market at the back of that. The top gainer in the past week is Hong Kong Land, with the announcement of the Singapore Residential Development Business, MCL Land. Okay. In terms of the top losers, we saw some of the banks in here. OCBC down by 2.3%, DBS down by 2.5%. due to concerns about the Fed rate cut on the impact on their net interest margin. Okay, what I wanted to share more about today is the newly launched IH Singapore Next 50 indices. So this is something that was just announced today, and the idea behind this indices is to allow investors a clearer view of opportunities beyond the Straits Times Index, which is a benchmark for Singapore's 30 largest listed companies. So what you see here would be that there are two versions of the index. We have the IH Singapore Next 50 Index and also the IH Singapore Next 50 Liquidity Weighted Index. Okay, so there are two new indices that are launched, and the intent is to track the performance of the next tier of the large and liquid companies on the SGX beyond the STI. Okay, so if you're wondering how these indices were actually designed, so effectively, what the index would take into consideration would be companies that are listed on the SGX main board, but they would already exclude the companies that are in the STI. So there are some liquidity and size screening that will then be taken, including that they will need to have a minimum turnover of 100,000 Singapore dollars per day. They will need to have a free float of at least 15%. So that would effectively then form the largest 50 stocks by market cap, with a limit towards the constituents where each stock will only take up a maximum 5% weightage in the index. The index will also be rebalanced quarterly in March, June, September, as well as December. Okay, so this is how the index is going to be constructed. And next, we are going to take a look at some of the names within the index. Okay, so I have split it up by the different sectors, and some of the names that you might be familiar with might actually appear in this index. So I see quite a number of stocks with a 5% weight in here, which represents the limit for any particular constituent of the indices. So ComfortDelGro, a name that many of us are familiar with, 5% weight in the Next 50 index as well as the liquidity index. Okay. The other name, Yang Zhejiang Financial Holding within the financial segment, also a 5% weight in the Next 50 index as well as the liquidity weighted index. Last week, I went through during the weekly market review, iFast as well as Propnex. So both of them are within the indices as well. iFast with a 3% weight in the Next 50 index and 5% weight in the liquidity weighted index. Okay, Propnex 1% weight in both of these indices. Okay, next we come to a few other sectors. We have consumer non-cyclicals, which would be a name that some of us might be familiar with, Sheng Siong, with a 3% weight in the Next 50 index and 4% weight in the liquidity weighted index. Okay, and then we have got the tech sector, a number of the hardware tech manufacturing companies here, including UMS, Franken, as well as STEC. Next, we have the telecommunication sector, including Netlink Trust, as well as StarHub. So Netlink Trust also has the maximum 5% weight in the Next 50 index. Okay, then within the healthcare sector, we have got Raffles Medical Group, and consumer cyclicals, we have Riverstone Holdings. Okay, the next sector is the non-energy materials capital infrastructure trust with a 5% weight in the Next 50 index. And then we've got a number of stocks, including companies such as First Resources, Penn United, representing this sector as well. Next, we have the energy sector, CSE Global, China Aviation Oil, as well as Geo Energy Resources within this sector. Okay, last but not least, a sector that many of us are familiar with, which is the REIT sector, representing the most number of stocks as well as the largest sector weighting within both of these indices. So within here, we have actually 4 stocks that are making up the maximum 5% weight within the next 50 index, and that will be CapitaLand Escort Trust, Kappa REIT, Suntec REIT, Parkway Life REIT. Okay, we also have got a name that represents a 5% weightage within the next 50 liquidity weighted index, and that is the recently listed NTT DC REIT, which I have also previously shared in one of the weekly market review. Okay, so as we can see from the list, the next 50 index is very significantly weighted towards the REITs, where they represent 17 out of the 50 stocks within the next 50 index. Okay, next we have the industrial sector. And then we have got 7 names within the finance sector. Okay, so industrials will be ComfortDelGro, like I shared earlier, and finance will be names such as iFast as well as Propnex. So from here, we can see that what are some of the largest constituents as well as sectors within both of these indices. Okay, next, we can take a look at how these indices actually have performed in the past. So if I were to look at the 10-year annual return, what we see here for the next 50 index is 5% per annum. And then for the next 50 liquidity weighted index, it is 3.1% per annum. So that is below what we have seen for the Straits Times Index, which is a 8.9% return per year over the past 10 years. Okay, but what we have seen is that there have been periods of time where these indices have outperformed the STI. So, for example, year to date, we have seen the next 50 index up by 24.6%. The next 50 liquidity weighted index up by 25%, outperforming the 19.3% gain for the STI. Okay, so there have also been other periods where we have seen the next 50 indices doing better than the STI, such as in 2019 as well as 2021. So effectively, we have seen certain periods of time where these indices have done better compared to the STI. And I think then it is up to us to determine which are some of these periods where some of these stocks beyond the STI have the potential to outperform given the macro environment that we are in, and from a bottom-up basis, how some of these companies are doing to unlock shareholder value. At this point in time, there isn't an ETF or mutual fund that tracks both of these indices. So for investors who want to actually gain exposure to these indices, you will effectively have to be looking at some of these individual stocks yourself. But what we'll be looking out for would be whether there'll be new ETF that are launched, new mutual funds that would then be benchmarked against both of these indices. Okay, so with that, we are looking at some of the key developments for this week, which will include the final US GDP data, as well as the US core PCE data. We also have the 6-month T-bill auction this week, as well as the Singapore Savings Bond application closing date. With that, I will hand over to Sunny, who will share with us the technical analysis.
All right, thanks, Gerald, for that coverage on the up and coming STI Next 50 Index. I think that's a very exciting time because we would have more coverage on those smaller mid-cap stocks that is performing very well in the recent time. So on that note, let me start off with the roundup of the STI Index on the technical front. So last week, definitely we saw the pullback of the STI Index. So this is not really a surprise because first thing first, all the attention of investors are focusing on the Fed rate cut last week, and that materialized. So that means that the direct impact on the STI index, which is making up of the three Singapore banks, their net interest margin will be impacted. Hence, there's some pullback on the banking stock that caused the pullback in the STI index. The next reason, of course, would be with the rate cuts happening, and of course, another 225 basis point cut as projected for towards the end of the year. That means that the environment of investors going into riskier stocks or more risk-on approach environment would also means that some of the capital might be leaving the Singapore or the STI index to invest in riskier options that are available in the US. Okay. So nonetheless, you can see that the STI is still sitting above the 4,300 points level. The STI all-time high is now seen previously on the 12th of September at 4,375 points. We are now resting on the green line, which is the 20 days moving average around the 4,302 points. And below that level, we actually had a strong support coming in given by the double top formation that we see in the month of July and August. So this double top formation around the level of 4,300 will also become a support level should the polarity change, and that could give the STI further support around 4,300. Below this level, we have the lower bound, the Bollinger Band in black, and the 50 days moving average, so finding some kind of a convergence, okay, around the 4,250 points or the 4,240 points level. So anything below 4,300 could be an indication that index may be oversold in the short term and poised for a technical rebound back towards the all-time high that we saw on the 12th of September. To double confirm that that kind of a formation playing out, let's look at the indicators. So MACD indicator is definitely now in the negative reading zone because of the pullback last week. But then you can see that that downside trajectory is not really that big. But so it's not a concern. But once it reached the 0 point neutral mark, a bounce could happen. So we do need to keep a lookout for that. If that coincides with the 4,300 level, that means that it could bounce off that level for a technical rebound, similar to what we see in the June period. On the RSI, we have also crossed below the 40 days RSI moving average of 64. We are now at a 55-point reading. So the 50-point neutral mark will be the first key support rebound that we are looking at on the RSI, which is what happened in the June period as well. When it breached below the 50-point neutral mark, a technical rebound happened and pushed the index higher. So that is the immediate support we are looking at on the STI index, with the RSI rebounding off the 50-point neutral mark at the 4,300 level. Below 4,300, the 4,250 points level by the 50 days moving average will provide further level of support for the STI index. So those are the opportunities that you can grab to get back in on the 30 stocks STI index. Next, let us move to the US indices. So Dow Jones Index is up by 1% last week. We can see that we have a new all-time high, as what Gerald mentioned earlier. The new all-time high now stands at 46,396 points. The closing last week was around 4,315 points, 46,315 points. So that is also closer to the top. So I think the Dow Jones Index is now definitely on the higher side because it has breached above the upper bound of the Bollinger Band at 46,250 points. So if let's say the trend were to push higher, the 20 days moving average will become I would not say the first support, but the first pivot that we are looking at, given that with the high momentum trending upwards, it has been using the 20 days moving average as a support. Okay, but let's say if you want to look at opportunities to get back in, definitely you are looking at the 50 days and the low bound of the Bollinger Band, which is closer to the 45,080 or 45,000 level to get back in on the Dow Jones Index. So index is elevated now, so do be careful. The MACD indicator, you can see that is, I would say, positive to slightly neutral. So meaning that the uptrend could have a chance of stalling or have a sort of going into a range-bound formation. That means that the upside might be limited going up from here. The RSI index now at 65, also 5-point reading away from the 70-point overbought level. Similar to the occasion that we've seen on the 3rd of July, there might be some kind of a consolidation move happening once it hits above the 70-point mark. So if you are into the Dow Jones Index, the top 30 stocks in the US, do keep a close lookout of that indicators flashing signs of a overbought signal. Hence, it could be prudent to take some profit off the table for now, going into the PCE index announcement this week. Next, let's move to the broader index, the S&P 500, which was the second best performer among the three US indices. You can see that we closed at about 6,664 points. The high that we reached last Friday was 6,670 points. So we closed nearer to the all-time high. We are also tracking the upper bound of the Bollinger Band very closely at 6,666 points. So the pivot definitely would be the 20 days moving average at 6,524, with support coming in at the very first level of the 50 days moving average at 6,421 points, supported by the low bound of the Bollinger Band at 6,382 points. So the S&P 500 do have a bit more upside momentum compared to the Dow Jones Index, given the MACD indicator reading is more positive than the Dow Jones Index. So that means that there would be more room for the S&P 500 to run, given that some of the companies here are more impacted during the rate hike period. Now that rate hike is happening, some of these smaller companies will be able to sort of grow up, have some gains on their stock market prices going forward into the year end, with two more 25 basis point cut being projected towards the end of the year. Lastly, let's move to the higher leverage, high tech stocks, high concentration of tech stock index, which is the NASDAQ Composite Index. So this is the best performer last week. The NASDAQ Composite Index up more than 2% last week, with the closing at 22,631 points. High was 22,645 points, reached during the mid part of the day on Friday. You can see that the MACD indicator, compared to the three US indices, this is the one with the sort of the highest positive reading, hence indicating the most momentum in the index right now. The RSI has already breached the 70 point mark level, now reading at 74. So we have to take note that if there's any sort of a mismatch amongst the macro indicators, like the PC index that's coming in this week, then the index will also pull back quite significantly. Okay, so the pivot will definitely be the 20 days moving average, 21,861 points. First support coming in at the 50 days moving average at 21,420 points, supported by the lower bound of the Bollinger Band at 21,100 points. Okay, so these are the key levels that you need to look out for the US indices. Otherwise, things are still looking pretty positive. We are still looking at some of headroom that the index could move up higher. With the PCE index coming in the middle of the week, that will give us more insight of where inflation is heading and whether the Fed would have an easier role that they can help manage inflation as well as the economic environment that we are in now. Okay, so that's all I have. Anything else we need to look out for, Gerald?
Yes, so I think we have some developments both in the Singapore market as well as in the US market. We've just seen the first rate cut by the US Federal Reserve in 2025. In Singapore, we see continued measures to boost the Singapore equities market, including the launch of the two new indices. So we'll continue to keep a lookout around some of the developments in both the US as well as Singapore markets.
Yes, and to stay updated with all this development in US and in Singapore, do stay tuned to our weekly market review, and we will always keep you updated with the latest market information that we have so that you stay informed as an informed investors. And this is the time that we have for this week weekly market review. We hope to see you again next week in the next weekly market review. Goodbye.